Hi, everyone. Welcome and thank you for joining us to learn more about Bella Vista Park. Wow, it has been a long time since we have brought a multifamily opportunity to our investors. And it's not because we haven't been looking, it's because we haven't found a deal that has met our standards. And a lot has changed since the last time we were talking about apartments. Adam, I was at the grocery store yesterday and I could not believe how expensive groceries have gotten.
Yeah.
I mean, seriously, I went to Costco, I got five things and it was over $100. But one thing that has not gone up in price the past few years?
What's that?
Multifamily.
Yeah.
Prices right now are at rock bottom in the DFW market. And this is just an amazing opportunity right now.
Yeah. And, price is important. But in addition, I think of the other thing that's really important when we're considering a multifamily investment, and that's safety, right? Want to make sure the
Mhm.
investment's safe. There's three big categories I think of when it comes to the safety of an investment. One, it's the people that are involved and the partnerships that are involved, the folks that are running the deal and executing the business plan. Two, it's the strategy, the business plan itself.
Mhm.
What does it entail? What's the context of how we're going to add value to this investment and make everybody money? And then third, the quality of the asset. When you're buying multifamily apartments, that actually is extremely important these days. How well cared for is the asset? What the last owner, in this case, the lender, how well did they care for the asset and how much money did they put into it for its upkeep? So that's what I think of when I think of safety in Bella Vista Park.
I agree. And we're going to go into all those details for Bella Vista Park. So let's get started. This deal is a partnership between A&E Investments, that's Adam and Emily, High Five Multifamily, and Fairmont Management Company. My name's Emily Cortright. This is my husband, Adam Roberts. We are A&E Investments. We've been in the multifamily industry since 2017 and have been investors in DFW since 2013. We've had three full cycle deals, and all of them have achieved fantastic returns for our investors.
Let's introduce our partners, Jimmy Edwards and Catherine Smeltz of High Five Multifamily. Emily and I are extremely grateful and excited to be working alongside Jimmy and Catherine. We've known Jimmy and Catherine for over 10 years. We got into the apartment business together. We share a track record prior to multifamily that's very similar in the renovation and repositioning of single family assets. And we couldn't be more excited. We've been investing alongside Jimmy and Catherine as limited partners now over those 10 years, and we've seen firsthand and experienced the output of their work. The stats on the screen speak for themselves. Really, the big takeaway is Jimmy and Catherine's primary core competency is repositioning distressed assets. You can see the three most recent exits on the screen, including one that was stabilizing a 50% occupied apartment community, heavy lifts. So Jimmy and Catherine know what they're doing when it comes to these type of assets. Let's introduce the property management firm, Fairmount Management Company. Started by Michael Kotwitz in the mid 90s, and now his partner Brett Lusky, who runs the operation. The really unique thing about Bella Vista Park and Fairmount is the fact that Michael and Brett are going to be equity owners in the deal.
Mhm.
They are going to be general partners alongside Jimmy and Catherine in the execution of this project. This is really good because it fully aligns all of the investors in this deal with the general partners and the management company. Again, the stats on the screen speak for themselves. They are highly, highly experienced in the Dallas-Fort Worth market. But I just couldn't be more excited the fact that Michael and Brett are going to be partners in the deal.
And what's important is Fairmont helped Jimmy and Catherine execute two of the heavy lifts from the previous slide. And so they were very critical. They have the experience in heavy value add, distressed properties, and they are going to be an amazing partner in this deal. So let's talk about Bella Vista Park's story. And I want to address something off the bat, and it's that this asset went through foreclosure. So I want to tell you why that's a benefit to our group. And it wasn't the property that failed. It was the previous owner. The previous owner mismanaged their capital. The lender, Fannie Mae, had to take the property back. And most importantly, Fannie Mae is not in the business of holding distressed real estate. So a government sponsored lender took a troubled asset. They injected over $1 million in of their own money into it, and they personally drove occupancy from 50% up to 77% before even putting it on the market. So we're not buying a problem property and hoping to fix it. We're buying an asset that has had over $3.25 million infused into it over the past few years. And the price is at well below basis, well below what it would cost to replace or to buy a stabilized property. So look at these numbers. 3.25 million has gone into roofs, foundation, sidewalks, fencing, HVAC units, interiors. They have done the hard work. All we need to do is fill the ready units and bring a 7 unit building back online. We're going to go into more details. Bella Vista Park, back to the basics. It's a 158 unit built in 1968. We're getting it for 11.6 million, which is right around 73,000 a door. And overall, this property is filled with 2 and 3 bedroom units. We really are going to be focusing on the family friendly amenities, and I'm going to talk more about that in a minute. But the adjacent neighborhood, there's a single family neighborhood right to the north of it, and then there's a new townhome community. All of those homes start at 350,000. So the demographic is a great demographic, and we're really excited about the location of this property. Now let me talk about the annex. We're going to reference the annex throughout this presentation. If you look at the shaded section on the Google Maps, Bella Vista Park, the main property, is literally across the street from this building. The annex is across the street from across Gross Road. And what the lender did is they put a fence around it, they put a brand new gate up, and they boarded it up. They didn't want to mess with it. So these units are currently down. They have been put aside for the new owner, so we can come in and we can make our changes. This is 2 and 3 bedroom units, large units. This is going to be a great family friendly area that is going to be the premium part of the property. I'm going to show you a rendering from the construction company. This is what it could look like when it's done. It's going to be beautiful and it's going to be the highlight of the property. Now, the interiors, like we mentioned, have already had so much money infused into them with the flooring, the fixtures, the cabinet fronts. 30 of the units have quartz countertops, brand new cabinets, stainless steel appliances. These are all made ready and vacant, ready to lease. The other really important thing to note is that the premium unit pricing is not underwritten into the pro forma. So we have units that look like this with quartz countertops, and we are not assuming that we're going to get a rent bump for them. This is one of the safety nets in our underwriting that makes it extra conservative. Now, our plan to stabilization, the lender took it over at 50% occupied. They have brought it up to 77%, which is at today. The next step is for us to lease 17 units over the next year. And again, these are made ready units. We do not have to spend a dime on these 17 units to get them ready. All we need to do is lease them. And that's less than 2 units a month that we need to lease. The other part of the business plan is rebuilding the annex, the 7 units, getting those back online within the first year. And that gets us to our 92% stabilization. The full Capex budget is 1.5 million. 700 of that is for the annex. It's going to be a complete rebuild on the interiors and even redoing the layouts to make them more family friendly. But then some of the other really cool projects across the property is that we are taking a current maintenance shop that used to be a secondary clubhouse. We're going to turn it back into a family center and a family clubhouse. So families are going to be able to rent it out for birthday parties, It's going to be able to be used for school activities, and it's going to be connected to a playground. So if you see the grassy area that's currently fenced in, that's where the playground's going to go. That fence is going to be removed, and the playground is going to be connected to the new family center. We do have another maintenance shop that's going to be on site and be able to be used for our maintenance, but that's one of the really exciting projects that I'm excited to see because it's going to really focus on uh, building community within our property.
All right, let's pivot to talking about the numbers in the deal and review the underwriting. I think once we finish reviewing all the figures, you'll see that it's conservatively underwritten, and there's really three primary takeaways from the financial projections. First, you're investing in a margin of safety, not a rent growth strategy. As you'll find on the next couple of slides, we're getting this at an extremely lucrative cost basis. And therefore, we're not paying for optimism. We're actually buying into a safe investment for which we have a lot of runway from a value perspective to make a profit. Second, the base underwriting case stands on its own. It's not dependent on certain circumstances or upside opportunities, significant rent growth, premium unit pricing, spectacular other income injections, or anything like that. We have a very simple business plan to reoccupy the property and get it back to 92%. And then we will look at potentially refinancing or exiting the deal. Third, things that are outside of our control, macroeconomic events, economic resets, recessions, things of that nature. If things go wrong, the deal still works. And we will show you our stress test underwriting and how we throw certain things at the underwriting through each parameter and find out that the deal still works. So let's dive right in. As you can see, Bella Vista Park is currently operating about 20 cents per square foot less than the primary competitors. Spring Hollow and residents of White Rock are considered our primary competition. They're setting the market rates. Our underwriting does not assume that we're going to actually move our rents up to this market price. It assumes that we're going to reoccupy the community to the market occupancy, and that's it. Any sort of increase in pro forma rents is pure upside to the projections. Additionally, as Emily mentioned, it assumes that we're not going to charge more for our premium units, which, as everybody who has purchased multifamily in the past knows, that those units will command a higher rent price, but it's not underwritten into our model. Looking at the 5-year pro forma and the cash flow projection, a couple things jump off the screen right away. On the income side, you can see the first couple years we are taking advantage of our business plan execution, reoccupying the units, rebuilding that 7-unit annex and occupying those units. And additionally, the prior owner and Fannie Mae were not good at keeping up with their utility bill backs. So the RUBS bill backs are very, very low, not within market. And so our underwriting assumes that we will be able to move that up to market and start appropriately charging the residents for their utility usages. So that's the first couple years, and then years 3 through 5, just modest income gains as we take advantage of historical market rent growth and things of that nature. On the expense side, and maybe even the more exciting side, Fannie Mae has placed forced insurance on the asset, and so the insurance is extremely high currently. We have a couple of insurance quotes that indicate that this insurance figure can be much lower. Secondly, the property is currently tax assessed at over $18 million. As you know, buying at the acquisition price and cost basis that we're acquiring it from Fannie Mae, $73,000 a door, that'll immediately come down to close to $11 million. So we can take advantage of real-time, immediate savings on insurance and taxes in the first year. It's going to be phenomenal. As you can see, cash flows are healthy, well above debt service throughout the 5 years. And with our conservative underwriting, like I stated before, this is just a base case. So could be some more excitement baked into it. All of this boils down to our base case projections, 16% IRR, a 2x equity multiple, and an 8% per annum cash flow. So really healthy projections given
Mhm.
the fact that the base case is a pretty vanilla underwriting. Let's review the deal economics and the capital stack, sources and uses. What I like to say is we're getting this asset at a distressed basis. It's not in a distressed state. It's in a very good quality condition. But more importantly, we're insulated from the current market floor. As you can see, the lowest comparable sale in the area, almost $90,000 a door. We're getting that almost $20,000 a door in discount, which is significant. And I really want to tip my cap to Jimmy and Catherine as they were doing the homework to get this asset under contract. There is a significant barrier of entry to getting a lender-owned asset under contract. There's a lot of hoops you have to jump through. There's a lot of relationships you have to be presented with the deal. And I just give them a lot of credit because that's where this value is coming from. That's how we're building in this built-in equity into this deal. So that's huge, and you can obviously see the average comparable sale in the neighborhood too. Um, Over on the uses side, I'll point out two very important things, which I'll actually talk about on the next slide more, which is the rate cap is part of our loan strategy, our debt strategy, and then the lender held interest reserve, part of that strategy as well. The acquisition fee of 2% is going to High Five as the lead sponsors. But overall, main takeaway is the fact that the distressed basis that we're getting this deal at is really building in a lot of equity on day one. Let's talk about the financing strategy for the deal. We have chosen the most appropriate loan for this asset, which is a non-recourse bridge loan. You can see the specs on the screen. It's a floating rate loan. We are getting an interest rate cap so that our interest rate through the term doesn't go above 7%. And it's a 3-year term with two 6-month extensions. Full term interest only, so that's critical for our cash flow needs. And I'll also discuss what I mentioned on the prior slide, which is the interest rate reserve. We are putting 7 months of interest rate reserve up with the lender at closing. And this is actually a win-win for everybody involved. What that means is the lender is going to draw on that interest rate reserve through the first 7 months of our ownership period, effectively leaving us with no loan payment. We will be able to use the additional cash flow to help us complete our business plan quicker in the first year, controlling all of our funds in-house, therefore not having to go to the lender all the time to do Capex draws. It's really, really a critical strategy for us as we get this property up above the 90% occupied point.
And it's important to note that this property, one, doesn't even qualify for agency loan at this point because agency requires 90% occupancy or higher. So again, the bridge debt is the best product. And what we've seen Jimmy and Catherine be able to execute in the past, Lubbock on Lakeway, they were able to sell within 34 months. And El Paso on the Park and Courtyards on the Park, they both sold right around the 2-year mark. So they have successfully executed strategies and deals like this very, very quickly under that 3-year term.
Finally, one more note about our underwriting. Even if we do a refinance in year 2 or 3 into agency debt, we've estimated that our interest rate will be 7% for the life of the investment, meaning not only will we have a 7% capped rate during the floating period, but if we refinance into agency debt, we're assuming that the going rates at that time are 7%, which, as anybody who's involved in the industry today knows, would be about a point and a half increase over today's interest rates. So we are assuming an increasing interest rate environment in this investment. There are some excluded scenarios, some upside to the underwriting. Emily mentioned the fact that we are not taking advantage of any rent bumps on premium units. I mentioned that we are actually not even bringing the current rents to market. We have upwards of a 20 cent per square foot discount on our rents, significant. So here are really the three big exclusions from our underwriting, which our team feels relatively confident that naturally we will be able to take advantage of. First and foremost is the rents, right? In any project, in any acquisition, you are going to naturally, your team is going to naturally charge market rents. Otherwise, we will be over-occupied with a waiting list. Secondly, as I discussed, Jimmy and Catherine have as part of their prior track record, exited deals in 18 to 36 months or returned capital through a refinance. So in our underwriting, year three NOI supports a potential capital return, but we've not included that in the base case. So keep that in mind. And then finally, from an other income perspective, there are things that the local market and our competitors are offering that the market is accepting and requesting, such as property-wide internet or internet that is provided by the landlord. Our base case assumes none of this. However, the market would accept about a 25 per unit per month rollout of internet, which again is just not in our underwriting, but a potential upside. Then finally, as we round out our presentation of the financials, it's always important to stress test the underwriting, any deal that you get into. Understand how it behaves under certain stress through the various parameters that you can test. And so, first and foremost, our upside model. So, the prior slide I presented those three excluded scenarios. If those scenarios actually come to fruition and we can take advantage of those opportunities, you can see the model outputs a 2.5 times equity multiple, north of 20% IRR, and north of 10% cash on cash return annualized. So, again, something that we're not underwriting to the base case, but we feel pretty confident about. And then below that, we tested three parameters that we feel, although outside of the team's control, and here's the important part, although outside of our control, we still want to make sure that the deal fundamentally works. First, economic vacancy. What if, for one reason or another, our team is not able to execute our business plan quickly? We think we can bring the 7-unit building online in the first year. Emily, myself, Jimmy, and Catherine have been involved in multiple ground up construction projects from a slab. So we feel confident in that. But what if? What if it takes 2, 3 years to actually execute that? And then you can see what the result is there. Cap rate expansion, something that's outside of everybody's control. If today's workforce housing cap rates are trading between 6.5% and 7%, well, what if cap rates don't stabilize? What if they don't go down? What if they go up? So an exit cap rate of 7.5%, and you can see we're still providing an acceptable rate of return.
Mm-hmm.
And then finally, rent growth. And this is really, when I look at this parameter, I think, wow, if we don't get any rent growth in the next 5 years, that's going to affect a lot more than multifamily apartments, right? That is a significant economic stress for the local area. So that essentially boils down to folks not having an increase in their wages, right? That's very significant. And still, the model outputs a return of investment, a profit, not only a return of capital, but a profit. So these we feel are significant stress tests, and it passes the test. When a deal passes a difficult stress test like this, it shows that it can withstand forces that are outside of our control.
Mm-hmm. Absolutely. So let's talk about the investment information. The hold period in the underwriting is 5 years. If we can, we will sell with earlier, well, 3 to 5. The minimum investment is 100,000, and the plan is to do quarterly distributions once the property is stabilized. Now, a lot of people ask about the depreciation loss. This is an estimate. Please check with your own tax advisor. But the estimate for the depreciation loss for this property is a $60,000 loss per $100,000 investment in the first year. Now, where are we in the process? The plan is to launch the 506C offering, meaning for accredited investors only, for both A&E and high five investors, the week of July 20th. Our final funding deadline is August 14th because closing is going to be August 17th. So you need to make sure to get in by then. Now let's talk about this entity structure. Adam and Emily, A&E, we have our own fund that we are investing into High Five's entity. And High Five's entity for Bella Vista is Buckner Boulevard. And then what is important to know is with the different splits is that whether you are an investor with A&E, with AE Invest Fund 1, or whether you are a high five investor investing directly, you are getting essentially the same split. You're getting the same returns. And that was on purpose because we didn't want to incentivize investors either way. So we didn't want a scenario where the high five investors made more or less than A&E investors. So the important thing to note with the structure is we've devised it so that both sets of investors get pretty much the exact same return. Pennies difference. That's it. Let's talk about investor onboarding and next steps. We're using a professional investor portal called Sponsor Cloud. And this is new to us. It's not new to the market. But what it means is that every single one of our investors in this deal is going to need to register for our investor portal. So you're going to follow the link. It's aeinvest.invportal.com. Every single person is going to need to register now. And then you're going to create a profile for the entity that's going to be the investor. So if it's an LLC, if it's a retirement entity, you're going to add a profile and complete a profile for the investor entity. Then you're going to review the documents. The digital signature process is very easy, but the important thing to note is that every investor is going to have to confirm their accredited status. And you can do that two ways. You can do that through a third party called Parallel Markets, which we've worked with before and has been really easy. And that is something that we pay for. The other option is to get a letter from your CPA. So you can go get a letter saying, I am an accredited investor, and you can upload it. We'll review it, make sure that it is not expired. Sometimes they expire within 90 days in case you've gotten a previous one. And so those are the two options to verify the accreditation. And then the third step is to either ACH or wire funds. ACH is preferred because it costs you and us less, but you can certainly wire those funds if you prefer that. So again, the website is available through the QR code, or it's just aeinvest.invportal.com.
All right. Well, we really appreciate you all spending some time with us to review this investment opportunity. Emily and I are super excited for it, if you couldn't tell. It really, like tying this all back together, what's important to us is a safe investment. Not all investments are guaranteed, but what can you control? You can invest in safe investments. And we really feel that at the end of the day, the context and the business plan, the ability to create value, the people that are involved in this deal and the folks that are going to be running boots on the ground, and then finally the quality of the asset. We feel like as a culmination, those really fit well and make this a safe investment. So as a result, Emily and I are super excited. Please get in touch with us. Don't hesitate to reach out if you have any questions, and we look forward to investing alongside you in the Bella Vista Park apartments.
Thank you.